We walked into 2024 risk on in the market, and the market, even though spreads tightened, yields were still pretty attractive. So the bid to high yield lasted throughout the entire year. And I think that's going to bring us into, as we get into 2025, we're going to see some more of the same. The high yield market's still up in quality. Spreads are going to be on the tighter end of their historic ranges, but all-in yields are still pretty attractive. And the market is going to be set up to buy yield, and I think carry is going to be a theme that's really, really important to investors as we go on throughout the year.
Similar to this past year, we think that elevated all-in levels of yields should continue to be supportive of demand dynamics for credit markets here as we enter 2025. One reason we believe that yields could remain elevated from here is that although the Fed has begun its rate cutting cycle, expectations for future cuts have moderated here more recently. If you couple that with where credit spreads are, even at the lower end of their recent ranges, that does suggest that corporate yields around 5% are possible here on a go-forward basis. As we've seen in the market over the last couple of years, this level of elevated yield has been relatively attractive to a broad part of the corporate market buyer base. Certainly, there has been an uptick in overall optimism around the growth prospects of the US and overall resiliency of the US market relative to other peers globally. And we think these factors combined could be a supportive backdrop for overall credit market demand.
We have seen very solid spread tightening across emerging market corporates. Now, of course, we have seen that really broadly in the credit space, but I think with emerging markets, what we're looking at in the corporate space is there a way to put this more in context to see, are we really at the tights of the range? So, when we look over time, people look at history and they compare it to maybe 2018. So we've been doing work looking at what is the compositional change. And what you see really is that it's moved up in quality. The space has moved up in quality. And so it may be tight optically, but is the value still there? And we think that you can find value in the space, especially compared to more of the developed market indices.
We're in 2024 with spreads in the leveraged finance market at cyclical tights. A lot of investors are wondering, is this it? Is there any more juice to squeeze out of these markets? To help us answer this question, we look at two factors. One is, where are we in the credit cycle? And the other thing is measuring the health of the corporate credit fundamentals. In terms of where we are in the cycle, we think that the soft landing that we're experiencing right now and the easing that the Fed is undertaking really puts us firmly into that expansionary phase. So in a sense, we kind of move backwards on the clock to a certain extent. That tends to be a good carry environment for high yield in a period where you're in a narrow trading range. From a health perspective, credit fundamentals are actually still quite strong, supported by strong profitability, and we expect that to continue. And that's important because it means losses are likely to continue to remain low as we go into 2025.
I think it's important to note that in 2024, we actually saw higher defaults in the leveraged loan market versus high yield. That typically, at least over the past number of years, isn't something that's happened. So we are watching out for that. But when we think about relative value and what we're thinking about 2025, we do think that there's going to be a pretty uncertain interest rate environment, especially with the new administration and perhaps the inflationary pressures that could bring. And so from that perspective and the uncertainty around interest rates, we do think that leveraged loans, given the structure of that product, might be a nice alternative within the leveraged finance space.
I think one of the bigger drivers of spreads in 2025 will be certainty or uncertainty related to the new administration that's coming into play in the US. So with potential tariffs as a factor and other things that have been presented by this new administration, it leaves a lot of uncertainty, and our market doesn't love when they don't know what to expect. So despite the fact that we do have solid credit fundamentals and yields that are still attractive, if we do have unknowns that come into our market, this could affect and drive spreads in 2025 and beyond.